Hi. Hey there, everyone. Dave Keller here with Market Misbehavior. Welcome to the show. Welcome to Chart This with Dave Keller. It is a gorgeous summery day here in Redmond, Washington. I was just talking to someone earlier today. We were sharing our disbelief that it's almost the midpoint of the year. We're in the last month of the second quarter of the year, which means we're just a couple weeks away from the longest day of the year. And those of you that are Canadian and or live in Seattle or one of those other cities in the sort of upper edge of the United States, the days this time of year get super long. I got up at 5:25 a.m. and the sun was already out here in Redmond, Washington. And after 10 p.m., it will also still be up. That's sort of the daylight we get this time of year. I'm going to be heading out the moment we're done. I'll be putting on some hiking boots and taking in a trail, taking a little forest bath, renewing and refreshing, reconnecting to nature, trying to just remember why we do all this stuff, staring at screens all day. I find balancing that with looking at some nature is a really good idea. Also, a healthy dose of music. Hope you guys are all doing well. We're currently live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you guys so much tuning in live. Those of you that are doing so, and I see some familiar names as always, welcome, folks, and thanks for coming. Thanks for stopping by. Please use that opportunity if you're watching live to share questions all along the live stream. Anywhere where you can drop a question, I can see it here on the live stream platform. We'll try to take a question or two at the end of the episode. We are also planning an all mailbag episode on Friday. So those of you that are watching the show later on our YouTube channel, thanks for checking it out. Feel free to like, subscribe, do whatever else you can do. Share it with a couple hundred of your investing friends. All of that is very much appreciated as we try to share this message of mindful investing with other investors. But please drop questions there for our mailbag. You know, as we talk about the market conditions today, kind of a choppy session overall. The real action, I would say, you know, some underneath the hood today, you'll find some big moves in technology, some actually excessive moves. I've got a couple examples of, I don't know how you can't label the current market environment, particularly in the technology sector, as anything but euphoric. That is the adjective that continues to roll over my lips as I'm trying to figure out how to frame out what I'm seeing in the markets here. You'll see stocks gapping aggressively because Nvidia's CEO said this could be the next trillion-dollar market cap stock. And I'll show you which name that is and how it went up over 30%, it looked like, going into the close. Having said that, though, on the same day, utilities, a fairly defensive sector, arguably with some growthy stuff in there at the top of the leaderboard. The Dow was actually up slightly, but the S&P and the NASDAQ flat for the day. The S&P 100 mega cap index down slightly for the day. So it is a very much a bifurcated market. And I was doing a monthly chart review earlier today for my Market Misbehavior premium members. And we talked about how on a relative basis, technology is pretty much the only sector where our market trend model is still constructive. The rest of the 10 S&P sectors on a relative basis, just not attractive, right? The trends are generally going down. So it's tech and then a big step down to everything else. All right, let's look at what happened today in the form of our market recap. We'll look at the heat map, and then we'll look at some charts that I've hand selected to talk through with you. And again, drop questions anywhere you can. All right, looking at the major averages, the S&P did close above 7,600. Yesterday, we sort of finished the day almost exactly at 7,600. And today we did close above there by just slightly around 10 points here. So not much of a change, to be honest with you. The S&P was up a token amount, 0.1%. The NASDAQ was, 7 points away on a 27,000-ish index. So that's 0.03%. So tiny change in the NASDAQ. The Dow, the best performer, up about 0.5%, but the real juice was in mid caps and small caps. That SMID cap trade has been really the story here. Certainly in 2026, especially in the second quarter, we've seen small caps and mid caps outperforming. The breadth in small caps is really the only breadth that still looks really good. I would say the rest of the breadth indicators did not confirm a new all-time high in May. Small caps, the only place where the breadth is still flashing some strength. Small cap S&P 600 outperforming. In my own portfolios, I'm way more small than large, generally speaking, because of that outperformance that we've observed. The VIX drifting lower, so we're back below 16. We're back around 15.8. So VIX below 16 is a very low volatility environment. This is one of the lower levels you're going to see on the VIX. I've not generally thought of that as a bad sign. Some people see a really low VIX and think contrarian sell signal. I'm not a big believer in that one, only because I've seen the VIX get down around 16 and stay there for a while. And you can see that just in the last 18 to 24 months, a couple examples where the VIX has kind of gotten low and stayed low while the market just kind of goes through this slow and steady uptrend. It has a similar feel at the index level to what we're seeing now, although I'd say at the stock level, it feels very different. But VIX down where it is basically telling you nothing to worry about. Options market are saying, move along. There's nothing to see here. Rates generally drifted lower today as bond prices went up. The TLT was up about 0.25%. 10-year point, 30-year point, 5-year point, all starting to drift down a little bit. So the 10-year point back below 4.5%. Generally rates have been going up for the last couple months. It's been sort of choppy here recently. We've been sort of in that 4.5 to 4.6%, 4.6% range. And for now, kind of holding steady. It's almost, honestly, if you look at the chart of crude oil, if you look at the chart of the 10-year, we're so programmed to think up or down, right? Is this bullish or bearish, right? We think in binary terms with many things in life these days, I would say, but especially with charts, right? I'm often asked, are you bullish or bearish on blah? And when you ask the question that way, when you think of it that way, you're missing that crucial third direction, which is sideways. Rates are generally sideways right now. Crude oil, while volatile, is generally sideways. Gold, while testing support, is still sideways. And a lot of those kind of macro indicators had big adjustments over the last couple months, with events in the Middle East sort of igniting. Now, as we're sort of in this perpetual dribble on one day to the next, still waiting for a resolution that doesn't quite come, these charts, I think understandably so, are in more of a sideways trend. And we'll let you know if and when they break out of those trends. But for now, kind of holding steady there. The dollar, literally no change after dropping in the afternoon. Looking at the commodity space, decent day for some commodities, particularly crude oil prices, which are bouncing higher. They dropped yesterday, kind of a nice bounce higher. Copper prices as well. Gold and silver up slightly. They actually opened up pretty strong, but still, finishing just above the zero level. Silver outperforming slightly, up about 0.5%. Man, crypto does not look good. And we've been highlighting that since Bitcoin's failed attempt to get above the 200-day moving average. We've been tracking this one pretty closely. I would say from a technical perspective, this is one of those times. Sometimes it feels like the charts are not as helpful as you'd want. That does happen. I would say Bitcoin is one of those examples. If you want to analyze a chart and think about how it would help you address a potential move, I think Bitcoin is a great example. Just a classic rally up to the 200-day moving average, a nice breakout, but then we stall at the 200-day moving average, and then we just drift lower. And now it's just been this nice, clear rotation to the downside. I don't think you have to be super sophisticated in your analysis of Bitcoin to recognize an accumulation phase, to recognize a failed breakout, and to recognize a new distribution phase. We've been lightening up on Bitcoin in our portfolios with it now below 70,000. The interesting thing about the chart of Bitcoin, as we'll show you in a minute, with drops like that, and this is one of the biggest down days we've seen, and this was, I think, Strategy announced, the former MicroStrategy announced that they were finally unwinding their Bitcoin position. That might be the bottom. We'll see if it is. Remember this one, because this is a big sort of, there's probably a better, more sophisticated name. We would always call this a puking out, like when the market's just kind of puking out this big sort of waterfall decline. And that often is like a big capitulation. We'll see. Bitcoin is kind of within the range of those major lows back in Q1 of this year, as I'll show you in a short while. Looking at the S&P sectors, with some of the ridiculously big moves in technology today, I would not blame you if you thought that the XLK was at the top of the leaderboard, but you would be incorrect. It was utilities, granted, which has some growthy elements to it, because there's a lot of energy, a lot of the technology we are looking at these days and using these days, huge energy requirements. So utilities have certainly been a growthy narrative, but the charts have not been particularly good. And I would say most of the charts of the XLU are not particularly great right now. But for one day only, they are at the top of the leaderboard. We'll see if that turns into something more lasting. But for today, the XLU up almost 2%, and that's the top performer. After that, you've got technology, which has been a standout in the second quarter here and consistently at the top of the leaderboard. Then you have the MEI stocks, the cyclical names, materials, energy, and industrials, all up over 1% today. 4 out of the 11 S&P sectors were down. Communication services, which just continues to struggle on a relative basis. I mean, one of the worst relative charts I could identify for you, down another 1.8%. There are some charts that are just really struggling in that sector for sure. Healthcare down 1%, and then the two consumer sectors also struggling today. So breadth was very mixed, and it really depends on where you look, right? If you look at the NASDAQ composite, 57% of that index was down today versus 40% up. If you look at the S&P 500, it was basically a coin flip, 52% up to 48% down. If you look at small caps, pretty decent, 60% higher to 39% lower. So the breadth was very mixed depending on which sort of area of the market you were looking at. I would say at best, this is a neutral breadth day. The breadth in the smaller and mid cap index is definitely better than the S&P and in the broader New York Stock Exchange, but generally not great breadth today. Sort of more neutral than anything. All right, looking at the Magnificent Seven and friends, these growth names, Broadcom popping today pretty well, up about 5%, leaving Nvidia in the dust, which actually drifted lower today. Kind of back, we're still testing that trend line that we highlighted coming off of the lows here in the second quarter. We cleared it, but now just continue to bounce around there. Apple up about 2.9%. That's good because I think that was down yesterday. On the downside, Microsoft struggling to follow through after a recent breakout. It's actually back below the 200-day moving average, as I'll show you in a moment. That's down 4.2% today. Alphabet down 3.9%. Those are obviously two of the biggest names in tech and in communication services. The underperformance of Alphabet certainly not helping the XLC right about now. All right, we will continue on looking at the market carpet. It looks like we're streaming fine on Facebook, LinkedIn, YouTube, and X. If you're tuning in live, thanks so much for joining me. I hope you find this helpful. Please use the comment section on any of those platforms to ask questions as we go. I am watching those comments and questions, and we'll try to take one or two at the end of the episode. Any of the ones we don't get to, and if you're watching our replay and put a question in our YouTube channel, we will gather some of those and hand select some to dig into a little deeper on Friday's all mailbag episodes. So make sure you tune in for that one. It's always a lot of fun. All right, so here's what happened on the heat map today. So first some high-level observations. I mean, obviously some very strong up moves and some very strong down moves. So this is, again, I mean, this feels to me like a very bifurcated market, meaning it doesn't seem like there's a lot of stuff that's kind of flat. It's like everything's up a ton or down a ton. These just big swings, which is so fascinating that the VIX is so low, because it feels like the individual stock VIX, if that were a thing that you could kind of roll up, I feel like that would be very high, because especially in some of the growth sectors, you're getting these violent swings one day to the next. I mean, the average day is seeing double-digit gains and double-digit losses in a lot of ways, or at least, significant moves to the upside and the downside, just in the technology sector alone. And even today within technology, you will see some big gainers and some big losers. Just stocks that outperformed big time and stocks that got absolutely crushed. Other than that, there are some themes that I want to just highlight here very quickly. But let's start with technology, because again, it's almost 40% of our S&P 500 benchmark these days. You have to think about technology, I would say, if you're trying to understand the U.S. markets here. So big continued upside in a lot of the semiconductors, right? And Micron has been one that I think is top of mind for a lot of people, because it's obviously had some pretty ridiculous gains, pushing above $1,000 a share in the month of May. But also look at Lam Research, LRCX up another 5%, KLAC up another 5%, Qualcomm up over 5%, Applied Materials up about 7%. These are all semiconductor names having some pretty awesome up days. In terms of hardware, you've got like Apple, pressing new all-time highs, up another 3% today. Other than that, I mean, it's sort of mixed with other areas. Storage names I noted on here were doing pretty well as well. Western Digital and Seagate STX. STX was kind of flat today, but Western Digital moving up another another 3%. The stuff that's red here, these are all the software names. Generalizing, but it's a lot of software, right? So Microsoft, Palantir, Salesforce, ServiceNow, Accenture, Adobe, a lot. I mean, they're not all software, but a lot of those are kind of in that software space. So today we're kind of back to the semiconductors over software. I wrote a note earlier today to my premium members, just kind of talking about this balance within the technology sector. I mean, the XLK is outperforming dramatically. That's been semiconductors in a lot of ways since the first quarter. But the biggest shift I've seen is improvement in some of the software names. But this week we're starting to see them give back a lot of those great names great gains that they've experienced. Right, charts like ServiceNow are good examples. I mean, just a really good break out of the lows. Nice bounce higher. This one's stalling out right at the 200-day moving average. Microsoft, which again I hand selected to review here in a moment, did this, but did it right above the 200-day and failing it. So looks like a bit of a give back here today on a lot of the software names. That a lot of those have had really good gains off the lows. What I like about those charts is a lot of the semiconductors are just crazy overextended. Not as many software names feel crazy overextended right now. But again, certainly a theme to be watching as some of those software names give back their recent gains. Communication services continues to be just a quagmire of bad charts. And that's from the big internet names like Alphabet. And I mean, to be honest with you, Alphabet's not a bad chart. I don't want to go too much into that because I did grab that to look at in a little bit. We will look at Alphabet. But I would say, the big three in communication services, Alphabet, Meta, and Netflix, none of those having a particularly great week. Meta and Netflix are ugly charts. Alphabet has been one of the better charts out there outside of technology, but in the last couple weeks, coming down off of a $400 share all-time high. Long-term trend is still positive. My market trend model, if you applied it to Alphabet, I would imagine would still be quite positive. The question now is, do we make a higher low, right? And that's what you want to see in an extended uptrend. Elsewhere out of technology, I'm seeing a lot of green in industrials, and charts like Caterpillar come to mind. Really good long-term charts, not quite breaking out, but I think you'd probably label this as a bull flag pattern. And that's a classic pattern you see in an uptrend where you see a big upward move. You see a parallel decline of lower highs and lower lows. It's honestly not a perfect flag pattern as I'm looking. You'd probably label that a coil pattern or like a pennant pattern. But in either case, breaking above the upper boundary, which it looks like we're just doing today, is pretty bullish. So the question is, if we get a follow-through day tomorrow, pretty bullish rotation for Caterpillar, ticker CAT, one of those big industrial names doing quite well. And that's not the only one. There are a number of charts in the industrial sector kind of showing that strength and just really, really close to having a new breakout. I mentioned the strength in utilities. I would say before you get too excited about this sector, there are not a lot of great charts in the utility sector, to be totally honest. There are a lot of names bouncing up today, but most of these are pretty bad charts that are maybe just bouncing off of very low levels. So I think too early to get too excited. Energy is a really interesting area. Crude oil prices are starting to bounce, right? And I would say that's what really caused this sector to struggle last week, was crude oil prices coming down, as there was a lot of optimism surrounding events in the Middle East. We still don't appear to be much closer to any sort of resolution, and you're starting to see crude oil prices pop up a little bit, and that's causing energy prices or energy stocks, that is, to do well. And I'm starting to see some of these when I'm looking for stocks making new 3-month highs. MPC came up on the scan earlier today as I was flipping through the charts. That's making a new all-time high. Other than that, I would say two sectors that stand out as struggling quite a bit. One would be consumer discretionary, and there are a bunch of charts like Nike that have been in primary downtrends that bounced a bit and now just appear to be resuming their downtrends. There are stocks like LVS that were bouncing last week that are now starting to rotate lower a little bit. So I would say consumer discretionary is still not a great sector from a technical perspective, and the healthcare sector getting absolutely dinged. Now, some of these charts obviously are coming off of new all-time highs. Eli Lilly stands out, breaking out to a new all-time high last week, that is. But now we're seeing a downside rotation. Your candle quiz of the day. Here's a 2-candle pattern on Eli Lilly. Oh, it's not, it's not a great example. So I'll still ask you. Anyone know what that pattern is? two candle pattern. And what defines a pattern like this: big up day, higher open, down day. And what's important about this pattern is you don't go below day one's open, but you go over halfway through that first day. So big up day, big down day. The down day does not engulf the first day. So there's hint number one. It's not a bearish engulfing pattern, but it does get at least halfway through at Acorn 1744. Congratulations, my friend. Correct answer. Larry, as always, you did get the correct answer, but you were beaten. You got beaten to the buzzer by Acorn 1744. Correct answer. Dark cloud cover, right? And so that, again, think of that as a two candle pattern that's suggesting short-term reversal. This is, honestly, charts like this are why candle patterns are so important to me. I'm not primarily a swing trader. My goal is not to trade little moves. But what I learned spending years working with long-term growth managers, if we can optimize our entry points a little bit, if we can see a pattern like this and say, all right, I like Eli Lilly as a fundamental story, but this is telling me today's maybe not the day to be adding a position because I'm probably going to expect some sort of pullback. If I'm just patient a day or two, I can probably get in at a weaker level. And so that's where things like the dark cloud cover for me are just super valuable because they help you just remain patient when it really behooves you to do so. All right, there's your candle patterns of the day, and I would say within healthcare, a lot of things like that, really good charts. Just pulling back here, I think a lot of charts like Eli Lilly, still good charts. They're just kind of pulling back, and ideally, setting up that higher low, giving you an opportunity to rotate higher. If you watched my webcast last week on trailing stops, you will know the 21-day EMA, also the chandelier exit, two things that I love to watch for that. All right, we're going to continue on here in a moment, going through some of the charts that I've hand selected to review with you. Before we do so, I want to let you know today's episode brought to you by our friends at EPS Momentum. If you like finding stocks that have real earnings growth and price momentum behind them, this is a tool you should definitely check out. It helps you surface companies with accelerating earnings, but also strong institutional buying. Here's how they do it. They have an earnings factor, which is based on earnings estimate revisions, which according to their research, which I've reviewed, it's been one of the most powerful drivers of long-term stock performance. That's something I learned in my Fidelity years. That's something I would truly agree with here in 2026. The institutional buying check, that comes from price momentum factors like ATR, average true range, volume, and other indicators. So it's looking for stocks where both the fundamentals and the market action are lightening up. If you want to check out their platform, you can use my link, marketmisbehavior.com/EPS. That'll get you 30% off your first payment on a new account. Again, go to marketmisbehavior.com/EPS. And thanks again to my friend at EPS Momentum for supporting Market Misbehavior. All right. Looking at the daily chart of the S&P 500, yet again, I'm bumping up the green shaded area. And when I keep saying that, this goes back to my Fidelity Fidelity years in the chart room. We would always laugh when the market would keep going higher and it would go off the printed page or the handwritten page. So we would have to we'd have to rescale the chart to make room for the new highs. And that is not necessarily a bearish sign, right? And there's a classic story where the market literally went through the roof of the chart room because they ran out of room on the ceiling, and so had to reprint redraw the whole chart. This is back in the early 1980s. The modernized version is every time the market goes higher, I have to redraw these green boxes and kind of bump them up a little bit. And when I stop having to do that every day, that's when I will tell you, maybe we're starting to hit some sort of exhaustion. Not today, though. The S&P making a new intraday and a new closing high, closing above 7,600 for the first time. The momentum is quite strong. We had a potential divergence, which we highlighted here about a week ago. And what we know when we have a divergence like this, it's a potential divergence, right? Because when you have the market going higher and you have the momentum going higher, we don't know where that next high is going to be. And so if we keep pushing higher and the momentum keeps improving, all of a sudden that divergence is no longer a divergence. And that's really what we've seen here. That's pretty normal behavior in a strong uptrend phase. What we want to look for is that new high that is marked by weaker momentum. This new high is not marked by weaker momentum. Looks like we're going to be nice and overbought with an RSI above 75. That tells me we probably have more room to run there. Hey, there's this thing called the Hindenburg Omen. You probably have heard of it if you've watched my content, because I don't talk about it often, but I do talk about it when it starts to fire. We had an initial signal on the Hindenburg Omen. I think that wasn't last week, it was the week before, if I remember right. That means we start the clock in mid-late May, so we have until mid-late June to have a second set of conditions that are all checked. What I'm letting you know is we have one of the conditions already, because the New York Composite Index is in a confirmed uptrend. We are very close to having a second item checked, which is the McClellan oscillator going below zero. Someone at JRoss 1977, great point. McClellan oscillator not looking that great. It's really close to breaking below zero, and that is actually one of the three components in the McClellan area in the Hindenburg Omen. That's one of the signs that was looked for, and that, because what that means is that the short-term breadth is starting to turn negative as measured by the McClellan oscillator. And that's basically looking at the slope of the advanced decline line for the New York Stock Exchange. So the McClellan oscillator going below zero basically says the trend in the advanced decline line is starting to slow down a bit, which is certainly how it feels. So the last factor, which is usually the toughest one to trigger, is that we need at least 2.5% of the NYSE listings to make a new 52-week high. We did get that every day for the last week, but we also on the same day need at least 2.5% of the NYSE listings making a new 52-week low. That's something we did not get. We got that about 2 weeks ago, which is why you see these groups of days where the green is over 2.5% and the red is over 2.5%. We need another one of those. I'm not concerned about new 52-week highs because we got a lot of technology sort of in that condition, and some other sectors as well. The question is, do we get enough new 52-week lows? So not quite a confirmed Hindenburg Omen, but if we would get that, that would be the third time in the last 8 months we've had a confirmed Hindenburg Omen signal. I would not bucket that under signs to be bullish, to be honest with you. Not quite yet, but we'll keep an eye on that chart for sure. Here's the chart of Bitcoin. You don't have to be, I don't think, a seasoned technical analyst to see that this chart has transitioned from an uptrend to a downtrend. I always ask, what would Henry say if I show him this chart? Henry's my 10-year-old son. He is not a trained technical analyst, but he can tell the difference between something going up and going down. And I've tested this with him years ago when he was like 6 or 7. I put charts like this in front of him and say, hey, which way is this going? He'd be down. There we go. Henry would say this is going down, and that means the chart's in a downtrend. Boy, who is that guy? There was a guy that used to come and visit us at Fidelity. His name was John Mendelson, and I forget the firm he was at the time. He was awesome. Just a classic technical analyst, hand-drawn charts, and he was getting up in age when he was coming and visiting us. This is probably 10, 12 years ago, and he said something like, I like a trend that you don't need your glasses to see, which was just an awesome, like, old-school technician thing to say about his hand-drawn charts. And I feel like this is one John Mendelson would say, you don't need your glasses to see this one. The failure at the 200-day moving average was warning sign number 1. The failure to hold the 50-day moving average kind of warning sign number 2. And now we're just making new swing lows, right? We're undercutting the previous lows. And so it's kind of missing all the support. The momentum now clearly negative. We're now oversold for the first time since the beginning of February. So what's interesting is I would say this chart is clearly in a downtrend now for a number of reasons. What I'm now wondering is, are we getting near that sort of long-term low, right? On the weekly chart of Bitcoin, you can see how those February, March, late March lows, kind of right around the mid-low 60,000s. We're kind of getting down into that level. I mean, Bitcoin below 60,000, like look out below. I mean, that's kind of undercutting all the support. The Bitcoin ETFs that I track are all seeing significant, scary outflows in the month of May going into early June. What you have to remember about cryptocurrencies, particularly Bitcoin, look at the history of Bitcoin. Huge drawdowns are not unusual. They're actually the norm, right? I mean, Bitcoin stands out and other cryptocurrencies for having ridiculous drawdowns, but also ridiculous uptrends as well. For now, this is something going down. I've been lightening up on my own position on Bitcoin ETFs because of that clear distribution phase. All right. Strategy Inc., ticker MSTR. This used to be called MicroStrategy. They famously sort of, developed into we're going to hold Bitcoin kind of holding company of sorts And if you look at the chart, it looks a lot like the chart of Bitcoin rotating lower. What's interesting, and the reason why I wanted to highlight this chart here is because they are basically just announced they're dumping their Bitcoin position. That was a big strategic move, was taking on a big Bitcoin position. That worked really well until it didn't. The last 12 months have not been particularly great. Back in June of last year, we're all around $400 a share. Now we're around 140. So that's a pretty big, here was like a 60, 70% drop from that peak. So obviously coming down quite a bit. The rotation lower is significant. Again, I think that shows you the relationship to it's the chart of Bitcoin. Is that dumping from one of the big advocates of Bitcoin a sign of a bottom? That's a contrarian play. We'll see. Now listen. If you're all bulled up on semiconductors, I don't blame you. If you think stocks like Micron are just getting started, like I get the argument. I've had the discussion. I get it. I would tell you there are so many bubble-like characteristics to what we're observing in the semiconductor space. There's no denying the opportunity in the space and the long-term play. I think that's undeniable, the transformation that we're seeing in artificial intelligence and how central semiconductors obviously are to that. But when Marvell Technologies, ticker MRVL, gaps up and closes up over 30%, because Jensen Huang, the CEO of Nvidia, speculated that this could be a $1 trillion company. I don't know how you can't describe that as frothy euphoria, right? That to me is like, that may be the bullet point. I feel like if we get some major top here, I think the bullet point we're going to have on the chart of the NASDAQ will be Jensen Huang, Nvidia CEO, says Marvell could be the next $1 trillion company. Having said that, what I've also learned, having gone through a number of bubbles over the years, there's plenty of money to be made on the left side of bubbles. And I remember having a heated discussion with a portfolio manager at Fidelity when we were talking about a particular asset and a particular very clear bubble happening. And his point was, look, I think you're right. I think it's a bubble, but there's plenty of money to be made on the left side of bubbles, right? We want to make sure that we follow those trends as long as possible. I can't miss a big rally in a key group within the most important sector in the US markets. However, I also want to be making sure that I use good money management strategies. That's why we did that webcast last week on trailing stops. That's why things like the 21-day EMA I find really important. That's why things like the chandelier exit are the exact type of indicators I'd be using on MRVL. I don't have a position in it. I'd probably be way more joyful today if I did, because it's up 30-some%. But for me, I think this seems like another bullet point on how frothy this market is becoming. Does not mean I don't own plenty of technology. And it doesn't mean I'm not riding that uptrend. As long as it goes up, I'm still going to want to do so. And that's what I would encourage you to think about as well, right? Be a trend follower. That means you follow good trends, even if you think there's a reason why it's going to peak at some point. It's not peaking today. Alphabet is one of those stocks that's starting to pull back a little bit. We highlighted a couple of weeks ago this shooting star candle, kind of a classic topping pattern as it was attempting to push above 400. We had that shooting star candle, which suggests some short-term weakness. From there, we had a nice bounce off of the 21-day EMA, but then continue to rotate lower. So we've broken that initial level of support. What's interesting right now is we're kind of right in this sweet spot. We're in the gap range, which was back here at the end of April. That was that big gap higher on Q1 earnings, right? You have this big gap here. We continued up to 400. We've now rotated lower, right back into that gap. I often think of price gaps as just support levels. And we've seen that a number of times, right? You have this gap, and I just kind of think of that as a area of support. That's where you often expect some sort of support to be found. Would not be surprised if we find some support here, but we're kind of at the last moment, right? We are testing gap support. We're hitting the 50-day moving average in about 10 points. The RSI is right at 40. So a bounce here would suggest a pretty classic kind of bullish long-term uptrend, weak short-term, making a higher low, making a move higher. If we go much further and the price breaks below that gap, price breaks below the 50-day, RSI goes below 40, I don't think you can describe that as a primary uptrend anymore. That feels like a steeper decline. And that's where I'd be looking down to the 200-day moving average, which is about 60 points below current levels. That's not a small drop. And that's 15-ish% drop down to the 200-day. So Alphabet potentially vulnerable, nice pullback, still okay if it can hold these levels. I don't think much lower would start to be a very different chart and a very different conversation. Amazon is still okay, and then it's holding the recent swing low around 255. We actually hit that today. What concerns me about the chart of Amazon is we're putting in a clear lower high, right? Or at least retesting that early May high. Instead of getting to new highs there at the end of May, we did not. Monday, we gapped down. Today, we drop even further. We're kind of right at 255. That's kind of the level. We break that, and I think this starts to look a lot weaker. RSI nearing 40 as well. Microsoft looked really encouraging yesterday with, Friday, we had that gap higher. Yesterday, we gap above the 200-day moving average. That's the first time since the beginning of January to be above the 200-day moving average. But today, gapping back down. So this is a 3-bar reversal pattern. A gap up followed by a gap down really implies a lack of willing buyers, right? I mean, think about what this means behaviorally, right? And with any patterns, with any candle charts, while I will always tell you about the signals and the levels and the specific, techniques, for me, it's all about behavior. These charts tell a story about what's happening behind the chart with all these individual investors and firms and everything kind of coming together and agreeing on when to buy and sell. And so what this pattern here over the last week tells you, a ton of optimism, renewed optimism, enough optimism to push us back above the 200-day, but then that was it, right? The buyers sort of were exhausted. There's no one left to push the price higher. And I would say today's drop kind of takes that breakout off the table, feels more weaker to me. Just a couple more. It looks like Palo Alto Networks is going higher in the aftermarket, but I'll take a look here really quick. PA and W. I mean, up slightly, just over $300 a share at the in the after hours. So coming up here a little bit. PANW, excuse me, one of those technology names surging higher in the month of May. I mean, through April, it's still kind of below the 200-day. That changed, and look at the gap, and then just look at the run higher. From that gap higher, we've only had like 1 or 2 down closes the entire time. So we're continuing to push higher, continue to see a strong upward trend. I think that's an upward trend, innocent until proven guilty. Tell you what's not looking good, exchanges. There's news that I actually had missed at the end of last week. I think this was out on Friday, where it was approved to have a Bitcoin ETF that's sort of a bit of an unstructured product. And that all of a sudden is questioning the assumption that all kind of important tradable products are going to be, funds that are listed on some sort of exchange. And I encourage you to dig into the news a little bit more. But kind of if you know how the prediction markets work, where it's sort of like an unstructured, kind of futured contract where you agree on what something is worth, they're actually approving that for Bitcoin. And what that means, they have not approved it for stocks or indexes, but it's not that big of a jump to think that it could go there. And as a result, exchanges like CBOE, NASDAQ, CME, ICE are all getting dinged pretty good starting last Friday. We can see that here on the chart of CBOE continuing lower on Monday and now on Tuesday. All of a sudden, we're back to the 200-day, testing it for the first time in over a year. So I would say based on that rotation lower and based on a huge threat to their business, I mean, the stock is going down quite a bit. From a fundamental perspective, now you have to start to question the stock's now gone down 100 points. That's a 20, 30% drop just in the last 2 weeks. Is that justified? Right? And are we overreacting? And I would say the RSI getting to oversold as we hit the 200-day. Maybe this is a time where we get some sort of bounce. Finally, Morgan Stanley within the financial sector. Morgan Stanley going higher, Goldman Sachs going higher, Interactive Brokers breaking out. Those are 3 stocks in that stock picking exercise, the webcast with Tom Boley that I did yesterday morning. Those were 3 on my list. I ended up taking this one in that paper portfolio, Morgan Stanley, but all 3 of them pushing higher today. I think a chart like MS is a great chart, right? Good breakout, good follow through, moving averages in the proper order. Great that the financial sector has stocks like this. They don't all look that great. A lot of the regional banks do not look that strong, but that's one that certainly is showing some strength here. All right, let's take a question or 2, and then we'll call it an afternoon here. And I'm going to go hiking. Sorry. I'm enjoying some of your comments here. Um, let's see. Yeah, I just mentioned Tom. He's uber bullish on semis, and he made a very bullish video this morning. I mean, listen, I'm not surprised. I respect Tom so greatly. He is a wonderful. I mean, he's become a great friend, and I enjoy the crap out of talking with Tom about anything, but especially about stocks. He's got a great laugh and a great way of going about things, which I appreciate. And I think his approach with combining momentum with earnings is obviously something that I agree with very much. I'm not surprised. When we talked yesterday, actually, none of us took semiconductor stocks in that stock picking competition, which we were all kind of surprised. We were all kind of expecting someone else to do it. So I'm glad that no one did. So now we're all underweight semiconductors. The problem is they're just continuing higher. The thing is that competition is looking out a couple months. And the question is, how much do you think that theme is going to continue? I'm skeptical, right? And I shared with you, I mean, I'm seeing so many bubble-like characteristics, but I mean, to Tom's point, he tends to follow momentum. The momentum's there. I can't deny that that's absolutely true. There's another chart that oh yeah, someone had mentioned the put call ratio. I see this one, and we'll add this. Larry, I think you would maybe put a comment about this equity and the put call ratio. Yeah, I'm so glad you highlighted that because I actually have not looked at that in a little while. Let's look at it together, shall we? So there's two put call ratios that I tend to look at. There's the equity only put call ratio, which we're looking at here, and then there's the total put call ratio, which includes equity and index options. And I think both are interesting at different times, but this is one that I find pretty interesting. The equity only put call ratio, and your point is we just hit a major low, and you're absolutely right. The way that I look at this, by the way, the gray line is the raw data. This is a daily reading, and it's super choppy. So one day to the next will have big movements. So I usually look at a 5-day moving average just to kind of get through the noise and just kind of look at the general trend in the series. And you can see that the 5-day moving average is at, as of yesterday, it looks like was at the lowest level that we've seen in years. We can go back even further to look at the longer history. I mean, this is literally the lowest level we've been in 3+ years. And the raw data actually hit the lowest point since back here, July of 2023. This is generally thought of as an inverse relationship. So when the put call ratio is super low, that tends to coincide with major peaks. And I'm highlighting some of these times when you had a very, very low put call ratio. You'll note a lot of times we ended up having a bit of a pullback after that. Thanks for highlighting that one. I actually hadn't looked at that one in a little while. We'll keep an eye on that put call ratio. Super low put call ratio, generally not a great thing. For me, again, as a trend follower, this is one of those like red flags that I look for. Then I look for signs of distribution. I look for signs that sellers are coming in, that buyers are exhausted. That is not something I'm seeing just yet. But hey, tune in tomorrow. We'll see if we continue to see any changing signs. Folks, thanks for watching today. I appreciate you tuning in live. Those of you that did so, if you're watching the replay on our YouTube channel, hey, take a minute and drop a question in the comments section. We'll plan an all mailbag episode on Friday. In the meantime, have a joyful, wonderful evening. And remember, it's always a good time to own good charts. Take care, folks.